there is a ratio that has quietly ruled money for nearly 5,000 years, a number that linked pharaohs and merchants, emperors and peasants, caravans crossing deserts, and banks wiring billions across oceans. That number is the gold to silver ratio, how many ounces of silver it takes to buy 1 ounce of gold. For most of recorded history, this ratio has hovered around 15:1, sometimes 12:1, sometimes 16:1, occasionally drifting for a while, but always returning, like a pendulum coming back to center. That stability wasn't decided in a conference room. It wasn't a target set by economists. It emerged from something far more fundamental, the Earth itself. Gold is rarer, found in lower concentrations, deeper underground, harder to refine, and used primarily as a store of wealth and symbol of power. Silver is more abundant, easier to extract, more versatile, and historically used for everyday trade as well as tools, medicine, and technology. Geology and human behavior converged on a natural exchange rate for thousands of years. Markets respected that balance. Today, they don't. Right now, the gold to silver ratio sits around 81. It takes roughly 80 ounces of silver to buy 1 ounce of gold. That is not a minor deviation. It is a historic distortion. To grasp what it means, imagine a world where, almost overnight, bread is suddenly priced at 80 times the cost of rice and stays that way. You would know instinctively that something is broken, not in appetite, but in the system that measures value. Whenever history has seen a distortion this extreme between gold and silver, the endgame has always been the same. The ratio snaps back toward its long-term range, and silver doesn't just go up, it is violently repriced. To see why, you have to rewind time. In ancient Mesopotamia, the earliest financial records written on clay tablets show debts and payments denominated in both gold and silver. Silver served as the primary medium of exchange. Gold was reserved for large settlements and wealth storage. The exchange rate, implied through these records, moved in a band that often resembled the now familiar 10 or 15:1 range. In Egypt, tax lists and temple inventories showed the same pattern. When silver supplies were temporarily low in Egypt's early period, the ratio fluctuated. But as mining networks expanded across the Mediterranean and Near East, the effective exchange rate normalized. Over the centuries, it stabilized near that same equilibrium, roughly 14-15 ounces of silver for 1 of gold. Egyptian scribes weren't targeting that ratio, they were measuring a reality they could not control. Greece and Rome refined the relationship further. Athens built its monetary power on silver drachmas, while gold coins handled high-level trade and war finance. Rome formalized the dual system with silver denarii and gold auri. Across wars, reforms, and debasements, Roman markets kept gravitating back to a narrow band. When emperors tampered too aggressively with coinage, the population responded with something stronger than a vote. They silently changed which metals they trusted, and the real exchange rate between gold and silver reverted toward the old balance. Meanwhile, in ancient China, a completely separate civilization, largely cut off from Western monetary ideas for long stretches of history, documented remarkably similar numbers. Chinese ledgers and government records show gold and silver trading around 10-1 to 16-1 through many dynasties. Different culture, different money, same gravitational pull. Whenever that ancient equilibrium was pushed too far, the results were destabilizing. The most dramatic case came after Spain discovered massive silver deposits in the Americas. For the first time in recorded history, a single empire flooded the world with new silver supply. Silver poured into Europe and then into Asia, financing wars, palaces, and trade. The gold to silver ratio surged above 31. Silver lost value relative to gold. Spain enjoyed a brief illusion of limitless wealth as silver coins filled its treasuries. But the illusion collapsed into one of Europe's earliest inflation crises. Prices soared, social tension rose, and the empire that distorted the ratio paid the price. The global system absorbed the shock, and, over time, the ratio drifted back toward its old range. No matter the culture, the continent, or the ruler, gold and silver kept returning to their natural relationship. Then, in the 20th century, something unprecedented happened. The ratio wasn't broken by geology or conquest. It was broken by design. Governments didn't just dilute coins, they rewrote the definition of money itself. The key turning point came in 1971, when the United States ended the convertibility of the dollar into gold. This decision finished a process that had been unfolding for decades. For the first time, major currencies were no longer tethered to any physical anchor. The last formal link between paper money and metal was severed. Gold was pushed into a new role, the ultimate monetary hedge, an asset that central banks continued to hold as insurance against their own policies. It remained a reserve, a strategic instrument, a backstop, even after abandoning the gold standard. Governments continued to treat gold as something different from ordinary commodities. Silver, on the other hand, was quietly pushed into the shadows. It lost its official monetary status. It left the balance sheets of central banks. It was no longer recognized as money in any formal sense. Instead, it slid fully into the category of industrial metal. And that's where the real distortion began. Just as silver was demoted in the monetary system, its industrial importance exploded. Silver's properties are unique. It's the most conductive metal known. It is critical for solar panels and photovoltaic cells, electric vehicles and their electronics, semiconductors and circuitry, medical devices and antimicrobial applications, telecommunications and 5G infrastructure, military systems and precision weaponry, AI data centers and high-performance computing. Crucially, much of this silver is used in tiny dispersed quantities. It's integrated into products in ways that make it technically possible but economically irrational to recycle at scale. While almost every ounce of gold ever mined still exists in some form and can be melted and reused, a large portion of silver is effectively destroyed as an economic resource once it enters the industrial cycle. Humanity stores gold. Humanity consumes silver. At the same time, the modern financial system layered on a powerful new mechanism: paper markets. Silver stopped being priced primarily by physical buyers and sellers. Instead, futures, contracts, derivatives, and other financial instruments began to dominate its trading. For every ounce of actual silver sitting in vaults, there could be tens or hundreds of ounces of paper claims representing obligations that may never require real delivery. This paper silver created a synthetic supply that did not exist in the physical world. As long as most traders settled in cash and didn't ask for the metal, the illusion could hold. The price could be suppressed by selling contracts, even if no one was producing enough silver to cover those promises in a true physical squeeze. Gold faces its own version of this problem, but silver's market is much smaller, thinner, and easier to manipulate. The result is a triple effect. Gold is elevated as the premier crisis hedge, silver is downgraded to a cyclical industrial commodity, and paper instruments flood the market with artificial supply. That's how we arrived at a world where gold trades in the thousands of dollars per ounce, while silver lingers in the low 20s, and the gold-to-silver ratio blows out to 81. But the ratio doesn't care about narratives. It reflects the relationship between two realities: a metal hoarded as insurance and a metal being systematically consumed by the very technologies that define the future. When you plug in the numbers, the distortion becomes obvious. Take gold at $2,400 an ounce, not a speculative moonshot, simply a plausible level in a world drowning in debt, chronic inflation pressure, and geopolitical tension. Now apply the long-term historical ratios. At 41, silver would be 60. At 31, silver would be 80. At 24.1, silver would be $100. At 21, silver would be $120. At 15.1, silver would approach $160. At 10.1, silver would stand near $240. For silver to reach $100, the ratio doesn't have to revisit its all-time lows. It doesn't need to crash to 10.1 or even 15.1. It only needs to compress to a level that, historically, was ordinary across centuries of human commerce. A sub-25:1 ratio was not extraordinary. It was common. If you zoom out even further, the idea that silver at current prices is normal makes less sense. The world is demanding more silver than it produces year after year. Global supply has been in chronic deficit. Mined output plus recycling fails to meet combined industrial and investment demand. The gap is filled by drawing down existing stocks. Above-ground inventories, once significant, are shrinking. At the same time, the mining industry is not ramping up aggressively to fix the imbalance. Primary silver mines are dealing with declining ore grades and rising costs. Many silver ounces come as byproducts of other mining operations. You don't double silver supply without disrupting copper, lead, and zinc markets. On the demand side, nations are pushing ambitious plans for electrification and decarbonization. Solar installations are expanding at a pace that would have been unthinkable 2 decades ago, each panel quietly consuming silver. EV adoption is accelerating. Data centers are scaling exponentially to support AI and cloud computing, building energy-hungry infrastructure wired with silver-bearing components. Militaries are upgrading to more complex, electronics-heavy platforms. Silver is no longer a luxury, it is a strategic material, and industrial demand is not speculative. It does not take profit. It does not panic sell. It is inelastic. When manufacturers and utilities need silver, they buy it. If supply tightens, they pay more. If prices surge, they raise end product prices. They don't switch the world's energy system or digital infrastructure off because silver is expensive. That is the core of the math. Demand is structural, supply is constrained, above-ground stocks are being drained, and the paper system is built on a leverage that only works as long as no one challenges it with sustained physical demand. Now layer on the monetary backdrop. Central banks around the world have returned to a behavior they publicly downplay, accumulating gold. Many are diversifying away from over-reliance on the US dollar, quietly building larger gold reserves. In a fractured geopolitical environment, gold once again plays the role it has played for centuries, neutral collateral between mistrustful states. Every ton of gold removed from the open market and locked into vaults reinforces the idea that gold remains the ultimate monetary asset. As confidence in fiat currencies erodes slowly, gold absorbs that anxiety. Its price reflects not optimism, but doubt. Silver, for now, is largely absent from this high-level game. That is exactly what makes its situation so asymmetric. As gold moves first, repricing to reflect the stress in the financial system, the ratio widens even more. Silver lags. It appears weak. It is ignored. But in every previous major cycle, that lagging period is not the end of the story. It is the prelude. Once the monetary stress is fully recognized, once gold has made its move, and once industrial demand collides with dwindling physical supply, silver begins to catch up all at once. History shows that when the gold-to-silver ratio finally starts to collapse from an extreme, the move is not gentle and not slow. In 1980, silver's surge from single digits to $50 cut the ratio down toward 17.1 in a matter of months. In 2011, silver's run from around $18 to nearly $49 halved the ratio from roughly 70.1 to 35.1 in less than a year. Those events were sharp, but they occurred in an environment that was, in many ways, less stretched than today. Debt was lower. Globalized supply chains were more stable. Energy systems were less dependent on silver-intensive technologies. Central banks were not accumulating gold at today's pace. Political fracture lines, while present, were not as deep. The pressures now are larger, more global, and more synchronized. This is what a supercycle looks like in slow motion. Monetary fear pushes gold up. Industrial necessity pulls silver forward. Structural deficits erode inventories. And paper markets sit on top of the entire structure, pretending it can all be settled with numbers on a screen. It cannot. At some point, a catalyst arrives. A failed delivery, a sudden policy shift, a geopolitical shock, an acceleration in energy buildout, or simply the cumulative effect of years of deficit finally hitting the limits of available metal. Once that line is crossed, the ratio begins to move, first gradually, then violently. From 81 to 61, silver doubles while most observers still call it a rally. From 60.1 to 40.1, institutional investors begin to realize this isn't a normal cycle. From 40.1 to the low 20s, silver stops being treated as a speculative side asset and starts being recognized as money again, whether anyone says the word out loud or not. Throughout that process, the world witnesses a wealth transfer, not the motivational kind people talk about on social media, but a mechanical one. Value migrates from assets that were artificially supported by the old system to assets that were artificially suppressed by it. People who owned real scarce, mispriced metal before the repricing didn't manifest wealth. They simply held the thing the system could no longer afford to ignore. In that kind of environment, $100 silver is not the top of the move. It is the entry ticket. It is the price level at which the market finally admits that silver never belonged at 81 in the first place. The ratio at that point is not extreme. It's merely on the path back to the same balance that merchants, kings, and empires used long before central banks existed. The story of silver is not about predicting dates or obsessing over short-term volatility. It is about recognizing a pattern that has repeated across civilizations. When the relationship between gold and silver is stretched beyond what the earth and the economy can support, the correction is not optional. It is inevitable. This is not prophecy. This is mathematics. geology, and history converging on the same conclusion: the gold to silver ratio will not stay at 81. It will revert. It always has. And when it does, silver will not politely drift toward $100. It will be pulled there, and likely beyond, by the same forces that have governed money for 5,000 years.